market flashing a warning sign for the U.S. economy. Two disappointing pieces of data from Germany and China, both painting a negative picture of global growth. And energy, financials, semiconductors are all leading the declines right now.
Let's bring in Michelle Ma, head of U.S. economics at Bank of America Merrill Lynch, and Tony Rodriguez, chief fixed income strategist at Nuveen Asset Management. Very good afternoon to you both. Michelle, have the chances of a recession in the U.S. been rising of late, and have they risen specifically today because of that 2s10s inversion?
So the chances of recession have been on the rise, and that's largely owing to the fact that we have a pretty big external shock that's hitting the economy, the trade war. And it's not just hitting the U.S. economy, it's hitting the global economy. And I think that's what was revealed today with the very weak data from China, the very weak data from Germany, really being driven by the fact that trade flows are down. Exports were down significantly in Germany, manufacturing was hit. So it speaks to the nature of the shock, and the U.S. is not immune to that. If the global economy is weakening, if trade volumes are down, the U.S. is going to soften as well. And we're seeing in the data has been softening. It's not in recession territory. Markets are obviously concerned with the inversion in the yield curve. We're not there yet, but there's a discrete risk out there that's starting to show through in the data in a pretty meaningful way.
Tony, we've been very focused on this inversion today, but you also had the 30-year yields, hit a fresh low. In general, when you look at whether it's treasuries or whether it's government debt globally, how much lower can rates go?
Well, we certainly have room to go lower because obviously Germany is kind of setting the low level for kind of a large liquid sovereign market, and their 10-year sitting at minus 80 basis points. So there's room to go further. I think the market is just reflecting, as Michelle pointed out, the weak data overnight does increase the risk of recession. I think it shows the market that the Fed is going to have to be more aggressive than what the Fed has been telegraphing they're going to do. So I do think you can see lower rates from here, but I don't think that we're necessarily anticipating in the second half of this year seeing the 10-year drop below 1%, for example, but there's certainly room for it to go lower.
Tony, one further question on the shape of the yield curve and its inversion. The UK yield curve also inverted today, but it's at lower levels, around about 0.4, 0.5% on 2s10s, as opposed to 1.4, 1.5%. Does that mean it's more bearish than it is in the US?
Well, I think in the UK it is more bearish. Number one, they have all the risks that come from what could be a hard Brexit and the uncertainty around Brexit. Number two, they do have greater exposure to the European economy than the U.S. does, and the European economy is clearly in a manufacturing recession and in a broader slowdown. So I think in the U.K. it makes sense, and it is a riskier situation there. I think the U.S., as Michelle mentioned, the fundamentals are still okay, but I think everyone's recession radar needs to be on higher alert as a result of the continued uncertainty on the trade front and the data that came out of Germany and China, which shows that global manufacturing recession, the intensity is certainly not abating. It's picking up, in fact.
Chris, U.S. versus the rest of the world.
Yeah.
I mean, certainly we've seen some softening data here, and we're seeing the sell-off again today. But is it still the best house on the block?
Well, the answer is yes, and it's been the case for the better part of the last 10 years, right? That has not changed. A question I might ask Tony here is, we have a yield curve inverted, but corporate credit really hasn't deteriorated to any meaningful extent. Is that a missing link? What are we missing there?
Well, it is a missing link. In fact, I think if you look at models that predict recession, if you use the Treasury curve, they sit north of 75, 80% probability of recession. When you use a corporate credit curve, they're below 50%. So just like the equity market, which is not far off of its all-time highs, the credit markets in the U.S. are certainly not sending a recession is imminent signal, but we have seen some widening in spreads, and I think the point is that the U.S. economy, while we're not forecasting recession, we're certainly forecasting lower second half growth than we were a month ago, and that puts us in a position where you're more vulnerable to an external shock, be it a geopolitical shock, like stress in Hong Kong, the election risk we saw out of Argentina, some of the Middle East tensions, and then, of course, you're certainly vulnerable to continued volatility and uncertainty on trade policy.
Michelle, how closely correlated does U.S. GDP tend to be to Eurozone GDP?
Well, I think, in this world where we have linked financial markets, where we are relying in terms of trade, global factories, we're very closely correlated. So one big economy sneezes, the rest of the world catches a cold. And I think that's the case today. And I think it's also because of the nature of the shock. The reason that we're seeing this weakening across the globe is because there is one big shock that's hitting all of the economies together. And I think that threatens to be fairly potent, depending on, of course, how it ends up playing out. So, do we think a recession is going to show up tomorrow? No, we don't think it's around the corner. But we do think that the risks are elevated. There's concern over how the U.S. economy is able to withstand some of these risks, especially given that we are in the later stage of the cycle. We don't have quote-unquote easy growth anymore, right? So the vulnerabilities are bigger to a sizable shock, and the risk is that we're seeing such a shock.
Michelle Meyer, Tony Rodriguez, thanks for joining us today.
Let's get a check-in on some of the key factors that we have been focused in on today. Meg Durrell is having a look at healthcare. Seema Modi's following energy. Frank Holland's covering the transports. But Meg, let's start with you.
But healthcare is doing better than most other sectors. Those stocks are down, but still among the best performing sectors in the S&P. Drug stocks in the Dow also holding up better than average. Look at J&J, Pfizer, and Merck there. And bigger biotech names are also down less than the rest of the market for the most part, particularly Gilead, Amgen, Vertex, all holding up the IBB, relatively speaking. Also contributing there is Amarin, which is actually up today after a positive initiation this morning in coverage at Leerink. And it's not so much that you can find safety in the smaller and mid-sized biotechs for the most part. As you might expect, guys, the XBI ETF, which is more influenced by those small and mid-sized biotech names, is down more than the IBB, which is influenced by bigger names. Wolf?
Meg, thank you very much for that. Now, the energy sector having its worst day of the year, the XOP dropping to all-time lows. Let's get to Seema Modi for more on that sector. Hey, Seema.
Wilfred, oil has been staging a nice rebound over the past week, but today it got caught in this broader sell-off that we're seeing. WTI closing down 3%, settling at $55.06. The primary reason for oil's decline is weak economic data from Germany and China overnight, coupled with the EIA data, which showed an unexpected rise in supply. Commodity experts now wait to see if the Saudis will decide to cut production to boost oil prices, especially if they want the Saudi Aramco valuation to stay at $2 trillion. Nearly all the stocks in the energy sector are in bear market territory, led by the oil producers like Devon Energy and Marathon Oil. But it's worth noting the big oil giants like Chevron, Wilfred, are faring better than their peers. In fact, Chevron, Hess, and BP are higher on the year.
Seema, thank you very much. Chris, quick comment on oil and energy sector. What's the charts telling you there?
Yeah, things in bear markets get hit hardest when the market gets hairy. And oil's been in a bear market for the better part of the last decade. We know it peaked in 08. It's been a series of lower highs ever since. It's the one spot where we see corporate credit weakness as well. High-yield energy spreads have started to blow out. And just put it in context, a month ago, Iran was in the headlines and oil went down, not up, right? So that informs the trend. That's a very different story than how oil would have responded 10 plus years ago. Sell stuff in bear markets, oil remains in a bear market.
All right, well, let's get a check on transports and how those are trading with Frank Holland. Frank.
And trucking stocks under a lot of pressure. Schneider National down more than 3%, seeing the biggest declines today in that area, following proposed changes to federal rules for truckers, adding a lot more uncertainty on top of tariffs and falling spot and contract rates. Landstar, along with Knight Swift, the nation's largest trucker, and J.B. Hunt, all underperforming the broader market. All 20 Dow transports in the negative. Avis Budget Shares, the worst performer, down 6%. Back over to you.
Frank Holland, thank you. We have got just over 15 minutes left to go here in the session. Joining us now to break down transports further is Helene Becker, Managing Director and Senior Research Analyst covering airlines and air-related industries at Cowen. Helene, great to have you today. The fact that we have oil moving lower and we have every component in the Dow transports, including the airlines, the commercial airlines, which should technically be benefiting from lower energy prices moving lower as well. What is that signaling?
Well, it's obviously the transports are in the airlines in particular signaling recession. And I would say for the airlines, we're heading into the fall, which is normally a time when demand falls off, especially after Labor Day. Holidays are over, people go back to school, and things don't pick up again until Thanksgiving and Christmas and those holidays. So, as of now, we're seeing very good bookings. We're seeing, sure, on your recent flights, you've seen how crowded the airports are and the airlines are. And our conference is coming up in a couple of weeks, and we expect the airlines to talk about a good third quarter and probably a good fourth quarter. With the grounding of the MAX, we've seen an artificially low capacity growth year. In fact, I think when we had forecast earlier this year that capacity would be up 3 to 4% this year, and now our forecast is kind of flat, plus or minus 1% or 2%. So we're actually seeing a decline rather than an increase in 2018, and demand is strong in part because airlines have been raising fares to kind of discourage leisure travel. So we should see a pretty good earnings year. I don't think the first normal year we'll see in terms of growth will be until 2021.
It's interesting to hear you say that. I mean, how would you compare? You're talking mainly about like passenger airlines, but I know you also cover some of the parcel carriers and cargo side of the air freight business as well. What is the data there telling you? And are those stocks attractive right now given the sell-off we've seen, or are they ones to avoid?
Well, so on the cargo side, Asia, U.S., especially China, U.S. Trade is down. Capacity in the market is down, so you're seeing big volume declines. I think with the exception of March, every month since November of last year, we've had cargo volumes decline, even while in some months we've actually seen capacity increase. So rates have come down, which is, if you're a shipper, that's obviously not a bad thing because your costs are going down after several years of seeing cost increases. As we head into the peak shipping season, we don't think we're going to have a very good peak. People will order online. Of course, e-commerce will probably be strong. It's been strong for the last few years, but the growth rate is likely to slow. And, we think when the dust settles on everything, a lot of really good companies are on sale, especially with this sell-off. And so we're taking a look and, probably want to own some of them. We're pretty optimistic on the outlook longer term. You can't have a good economy without having a good airline industry.
Helene, thank you very much for joining us. Helene Becker there. Let's get a quick check-in on semis, which are getting hit hard. Josh Lipton has more from San Francisco.
So, well, if you look at the SMH, that's an ETF that tracks the chips. It is still up strongly this year, but obviously it is taking it on the chin in today's trade, in the red and now in correction, meaning it's dropped more than 10% from that recent high in July. A couple big worries weighing on chip names. One, obviously, these renewed concerns about the U.S. economy. These are cyclical names. They are economically sensitive names. Also, continued trade tensions. A lot of these chip companies, they depend on China as an important end market. It's also a critical part of their supply chains. If you're a chip investor, what do you do now? Where are the investment opportunities, if at all? I checked in earlier with RBC's Mitch Steves. He still does see opportunity. He likes Synopsys. He thinks that's a defensive name. It sells software tools to design chips. Mitch argues even if you go into an economic downturn, that should hold its own. He also does like AMD and NVIDIA because he thinks they'll continue taking share from Intel in the data center market. But all three of those names, as you guys can see, in the red in today's trade. Back to you guys.
Josh, as always, thank you very much. We've got 12 and a half minutes left in the session. We're down 735 points on the Dow. The low of the session was down 794. Let's bring in Art Cashin from UBS and Randy Federick from Charles Schwab on the phone. Art, what are the market on close orders and expecting a bit of softness into the close?
Yes, the bulls are going to be on defense going into the close. About 10 minutes ago, the indications were for over $1 billion for sale on balance for the bell. Normally, that would be strong enough to move the Dow down maybe 20 points or so. So they're going to have to be on defense. The Dow has taken out the 200-day moving average. It has moved lower than that. It has stayed above the August lows, which are 25,440. And we're also looking at the S&P August lows, which are 2822. So it's going to be a very defensive final 10 minutes.
And Arthur, just in terms of the factors that have weighed on the market today, clearly the shape of the yield curve, clearly that international data. Anything else that you're hearing? We haven't really touched on Italian political risk and Argentinian peso. Are those factors as well?
Oh, absolutely. And the face-off between Pakistan and India, two nuclear weapons nations that are going nose to nose. And the Hong Kong demonstrations and some demonstrations in Russia. So the geopolitical backdrop is not healthy at all.
Randy, let's talk about the levels that we've seen in the market. As we just heard from Arthur, we've gone through the 200-day moving average on the Dow. What are the key levels you're watching as to whether you're expecting more downside from here in the short term?
Well, I am keeping an eye on the S&P 500, of course. That's kind of a better, broader gauge of the overall market. And, we're only down about 6% from the July 26th high, and we're still up over 13% year to date, so that's not too bad. What I am looking at from a technical perspective, which I think is kind of important, is that 10% correction level. That's where I would remind people to keep an eye on, because it sort of converges with the lows of the March and June pullback, and they're both within just a few points of each other. So I expect there to be a fair amount of technical support there, but the only stopping point between here and there is really the 200-day moving average, which is around 27.95. So if you look at that, we're still talking about a potential for another 50 points before we hit any sort of slowdown speed bump.
Chris, is that how you're thinking about it from a technical standpoint as well?
I'm thinking about it from a behavioral perspective, from a sentiment perspective. Are we seeing the type of stress and fear that often shows up near a market low? I think one of the big changes today are, and probably you saw this too, is the big spike in put call ratios start to finally show up in this market. You look for spikes of put calls near lows. I'm not sure we're there yet, but it's a start. That data can be a little bit early. We've also seen really big outflows from the spider over the last 15 days since the market peaked. Only $25 billion of flows there. So there's a flush going on here in the sentiment world that I think is notable.
Arthur, we actually had good news yesterday on trade. Does the market now say that it doesn't care about that good news? What's the key factor from here going forward?
Well, the good news was somewhat short term, and it was much more of a relief rally. It was not the start of a new upward move. Yeah, trade will be important, but you're going to need to see something more constructive than a temporary delay. When they looked all through that, the feeling was that it was somewhat less about trade and more of a chance to give a sigh of relief to President Xi with everything going on in Hong Kong, take pressure off on trade and give him some room to maneuver. So it might have been a gift from President Trump, and that's why it has not held.
How does this compare? This August, historically, light volumes tends to be volatile. How does this compare to what we've seen in August's past?
There is a comparison. One of the reasons that August has a history of being volatile is that many people are on vacation. Therefore, markets are thinner. So a little bit of selling has a more disproportionate influence because you're selling into a kind of vacuum. We saw some of that today.
Randy, how concerned are some of your clients about the yield curve inversion? Do you think it is specifically a factor that has led a lot of people to sell today?
To some extent, yes, and I think there's no question that there were some program trades tied to it, which clicked off right at the open and when we saw the inversion. Now, we're not inverted at the moment. As the day went on, we got away from that. But it's important to keep in mind that this inversion is one of a number of signals that signal a potential recession, and the typical lead time here is about 12 months. And during that time, it needs to stay inverted. We've only been inverted for just a very short period of time today. So, yes, it is something to be aware of, and I know there were some trades that were tied to it, and we're probably seeing a few of those here right at the end of the day as well. But if it levels off from here, and keep in mind we've got another Fed meeting coming up here in just a few weeks that are in all likelihood, I mean, the market's pricing in 100% chance of a cut, and frankly a 36% chance that cut could be 50 basis points.
Randy, it looks like we're going to close at or near the lows of the session. Assuming that's the case, what are you watching overnight, and what do you expect to happen at the open tomorrow?
Well, the most important thing that I watch is I come in here a few hours before market open. I want to see what the pre-market futures are doing, because as while our surprised me, assuming there's no other news out there.
Randy and Art, thank you both for joining us as always. Chris, again, your take into the very short term. Do you think we get a bounce yet, or short term still some weakness? Even though you're kind of optimistic.
Yeah, I still think in the tactical sense we need to flush this a little bit deeper. Those 28, 22 lows from last week, even the June lows, 27.30 or so, I think ultimately are going to have to be seen here. Remember, a lot of the secondary groups have already broken those lows from last week. We've seen it with the semis, we've seen it with the banks. I would expect the S&P to follow.
Pullbacks, corrections, healthy part of a market, right? But the fact that we've seen these moves so fast and so furious, is there anything to be gleaned from that?
You know, it's really reminiscent of 2012. Like, think about where we were in 11. We had a big 20% shakeout in the fall of 11. And then 2012 was one of those risk-off years where the market grinded higher. You had two 10% drawdowns, one in the spring, one in the summer. and the pain trade was higher all year long. This feels similar. We've had very defensive leadership, and I would just ask, where are the excesses right now? Are the excesses in cyclically driven stocks, or are they in staples, REITs, the areas that have been most bid up over the last number of months? I think it's a very important question we need to ask ourselves.
Let's check in on the markets with just 5 minutes left of trade. Here's the sector heat map view on the S&P. Red across the board, as you can see. Utilities, the best performing sector, but still down 0.8%. At the bottom, energy down 4%. Financials down over 3% as well. 2.6, 2.7% is the decline for each of the major indices.
Chris, you want to get your last chance trade?
When you look at the action out of the oil market today, I think it is confirmation crude remains in a bear market. The rally yesterday evaporated in 15 minutes this morning, right? So when you look for how things behave in weak markets, it tells you a lot about the trend. I think crude lower. I think the weakness in energy credit is another ominous sign there.
All right. It's definitely one to watch right now. We've got less than 5 minutes to go in today's session. It is time now for the closing countdown. Let's trade the close with Herb Morgan, Chief Investment Officer at Efficient Market Advisors. Herb, what are you watching going into this close?
Well, like everybody, we're watching to see the volume into the close, but right now we're focused, like a lot of people, on this yield curve inversion. And yes, 4 inversions in the last 40 years have preceded recessions, but we really think that this one is incredibly different. I mean, back in 78, you had high inflation, Fed hiking rates, they continued hiking rates. In 88, high inflation, Fed hiking, continued hiking. In 2000, you had an asset bubble that they were worried could lead to inflation, obviously in stocks, 27 times earnings. And then in 2005-06, you had the real estate bubble. This time we don't have that. So with the Fed already having cut once, likely to cut again September 12th, a BOJ and an ECB in September likely to ease, we think this selling pressure is going to pass, and it's a great time to accumulate equities.
Okay, you just laid out how it's different than times previous. Does that mean that its veracity as a recession indicator can be called into question?
Well, I think you've got 4 for 4. I don't think 4 for 4 is a high veracity indicator of anything. I mean, in statistics, we need 100 data points to make a conclusion. We certainly don't have 100 yield curve inversions, so we have to look at the 4 and say, what do they have in common and what's different now? And then we can make that conclusion. And I just don't think we can draw a U.S. recession conclusion from this inverted yield curve. Slowdown, yes. But think about the major fiscal reform we had with the Tax Cut and Jobs Act, significant deregulation. Now these ultra-low interest rates stimulate the consumer. They stimulate business demand. They help with CapEx. 7 million job openings for 6 million unemployed. It's hard to envision the U.S. headed to a recession right now.
So, Herb, just quickly, are we oversold today then?
Yeah, I think we're close to oversold. Look, we had a higher high in the last high. We had a higher low in the last low, early August. The market trend still looks up. I think you could get a little further down, and then you'll get to that oversold indicator, but that's timing the market. I'm an investor. We're in for the long haul.
Morgan, thanks very much for joining us. Let's get over to Rick Santelli for the bond report. Rick.
Yes, Wilf. You know, a month to date of 10s minus 2s pretty much tells the story of one of the triggers in market behavior today as it was flirting in and out of negative territory, first time since June 2007. If you look at an intraday of 10-year note yields, we dropped about a dozen basis points, although it was quite orderly. Finally, a year to date of 30-year bonds, which are making history today, lowest closing yield ever. Keep this in mind. Closed at 301 last year. We're down 100 basis points. Bertha, NASDAQ doesn't look nearly as good in red as a sports car.
Yeah, definitely not, Rick. And we're seeing it all across tech today. We're watching as some of the tech sectors that have held up the best, like software, are starting to get near where chips are in terms of being in correction. The software sector now off about 9%. I've been watching Apple, though. If you take a look at Apple today, it's been a relative outperformer. It is still more than $10 above the lows that it saw on August 5th, which is what we're starting to look at, whether we'll test test here on the NASDAQ. And Apple is actually still up for the week by about 1%. So that is holding up relatively well in tech. But other than that, you see a lot of red. And in fact, as of this afternoon, it looks as though the Russell 2000 is going to close below last Monday's low. Bob?
Bertha, we are closing essentially at the lows for the day, and that August is starting to look a lot like December and a lot like May. That is, global growth concerns knock down the big cyclical names, including the industrials and semiconductors, and they tend to prop up the more defensive names, that being, of course, companies like gold, utilities, real estate, and consumer staples. There's the closing bell. The Dow Jones Industrial Average looks like it's closing down close to 800 points. That would be right near the lows for the day.
If you're just joining us, we closed at the session lows, down 800 points on the Dow. Welcome to the closing bell. I'm Wilfred Frost.
And I'm Morgan Brennan in for Sarah Eisen. Mike Santoli is off today, as you just heard Wilf mention, closing at session lows for all the major averages. The Dow finishing down 3% or 801 points, 25,478. This is the worst day since December 4th. S&P also closing down nearly 3%, 2840. The NASDAQ down 3%, 7773. The Russell 2000, the small cap, sliding further into correction territory, also down 2.8%.
800 points. Let's just pause and dwell on that. Over 3%, a massive decline for the Dow. Well, for all the indices, 3% handle on the NASDAQ as well. Close to it for the Russell and the S&P. Every sector lower. Utilities, the only sector that wasn't down a full percent. The rest were. We've got 5 sectors down more than 3%. Massive selling across the board. And we've got full team coverage coming up of this sell-off. A panel of experts all here to break down today's moves.
Plus, Mohamed El-Arian is going to join us to weigh in on this market. Stay tuned for that.
But first of all, let's get to Bob with a breakdown of how we got here and a full run-through of today's crazy market action. Bob Pisani.
And August starting to look a lot like December and May. Cyclicals underperforming, defensive sectors outperforming. Take a look at the major cyclical groups. Retail down 4%, energy down 4%, industrials, banks. This has been this pattern. It was the pattern in December and January, the pattern in May. At the same time, more defensive groups tend to be outperforming, although it doesn't necessarily mean that they're to the downside. So gold, for example, up today. That's a standard pattern. Utilities only down fractionally. REITs down 1.5%. Consumer staples still moves down here, but much better, half the decline of the overall market. Want to point out that even though we have a lot of concern out there, we're still only 6% off the recent highs in the S&P 500. This is not even right now a garden variety correction, down 10%. NASDAQ's only down 6% from its recent high. Dow Jones also 6.8% from its recent high. The Russell 2000 down about 15%. Small caps have had a much tougher time overall. Key levels to watch. We closed today about 2840 in the S&P 500. The recent low, the last closing low last Monday, the low 2844. So we are essentially breaking through that recent low here. The 200-day moving average for the S&P 2795. That's so we're a good 45 points away from that. Correction territory overall, 10% for the S&P to the downside. That would be 2723. And guys, still a ways from that 10% territory. Back to you.
Bob Pisani, thank you. Joining us to talk about this market day, Jeff Stott, Chief Market Strategist at Capital Wealth Planning. Joseph Tanios, Principal and Senior Investment Strategist at Bessemer Trust. I hope I got that one right. Chris Verone is still here, Partner and Head of Technical and Macro Strategy at Strategas Research Partners. Good afternoon to you all. Jeff, I'll start with you. For the folks that may be retail investors or the mom and pop out there that's invested in this market but doesn't participate or check on their portfolios on a daily basis, I mean, to see an 800-point drop in the Dow, that's certainly got to be scary. If you're tuning in right now, what would your message be to those long-term investors?
Oh, I think Wilbur Ross said it this morning that this inversion, so to speak, of the 2 and 10 and being that negative on it is a bit aggressive. And I would tend to agree with that. Our short-term model flashed a cautionary signal 3 weeks ago, and we actually wrote about it and raised a little cash, but I certainly didn't expect anything like this.
Joseph, what's your take?
Well, I mean, I'll echo a lot of the sentiment that's already been relayed out there. I think it's important that we don't overreact to how markets behave in any one particular day, especially day in August where we know liquidity is relatively thin. Having said all of that, when you have the S&P 500 up over 20% just in the first 6-7 months of the year, and the underlying fundamentals in the U.S. economy and in earnings are slowing down, I think you have to approach this market with a little bit of skepticism, and you have to look for ways to take a little bit of risk off the table.
Chris, the fact that we closed at lows of the session, what does that tell you?
It shows how indiscriminate and broad selling was today. I think if you look at the AD data, decliners outpaced advancers, maybe 16 to 1, 17 to 1. So it was broad-based across the board. That is the type of flush that you tend to see at or near low. And I think just the response and the sentiments we've heard shows how fragile behavior still is. We're only 15 days off the S&P making new all-time highs. And the way people are talking and behaving, you'd think the S&P is down 20 or 25. We already had that. It was December of last year. It's difficult to find back-to-back 20% drawdowns in calendar years.
Jeff, I get your point that you're not too concerned specifically about the 2s, 10s inverting, but what about some of the factors that caused it to invert this morning? Chairman and China GDP growth data points disappointing, Argentinian peso sliding. Are you watching those factors closely?
Yeah, well, there's a lot of moving parts out there. You got Russia blowing up their own weapons. You got Chinese troops massing on the Hong Kong border. You mentioned Venezuela and Argentina, India and Pakistan that my friend Art Cashin mentioned. So you got a lot of moving parts out there. But I think this is an overreaction. We're probably going to test the August lows, maybe get a slight undercut low. But I still think we're in a secular bull market. I think the inversion of the 2s to 10s is not the right yield curve. In my 50 years in this business, the real yield curve has always been the 90-day T-bill and the 30-year bond, and that's nowhere near inversion.
Jeff, I know you watch or you keep track of Dow theory as well. What do you think the transports are telling us here?
Well, we're close on the transports to break in, to a new reaction low. The Dow Jones Industrial Average, however, is not. I just looked at it in the green room before I came in here. So right now, you don't have a Dow theory sell signal.
Joe, which sector would you want to be buying in today's sell-off?
Well, I think broadly speaking, it's important that you think about your regional allocation, right? We talk about the U.S. sort of being the best house in a lousy neighborhood, and in many respects, that argument still remains the same. I think taking it one step further from that, you want to be positioned and exposed to those sectors that stand to benefit from the healthier parts of the U.S. economy. So I look at the U.S. consumer. I take a look at the household net worth, the balance sheet, take a look at what's happening in the labor market. I want to be exposed to areas like technology, consumer discretionary, things like that that stand to benefit from just a healthy consumer. But going just beyond that and thinking about sectors, I think it's also important to be positioned in a way where you can withstand what we expect to be a pretty volatile back half of the year. So I look at other low volatility equity strategies, and these are the types of things that we want to have in our client portfolios.
Let's bring in Steve Leisman, given that we've seen that massive macro move in the yield market today, which of course hurt equities. Steve, what's your take in terms of how significant this 2s, 10s inversion could be? You've been looking at lots of the other past occurrences.
Yeah, I mean, the trouble is when it goes negative, it tends to stay negative, remain negative for a long time, and it does tend to signal a recession. The caveats this time, Wilf, are whether or not yields being so low and where they are, and with so much of the world bond market with negative interest rates, whether it's a different story this time, and we just don't know. We do know the global economy is weakening. I think these bond yields correctly reflect both the outlook for growth globally along with the outlook for inflation, which is very muted. And I have to say, I think the Fed will respond. I think the market is somewhat thinking about a 50 basis point cut in September. But I think if these if these yields were to remain where they are, and the stock market will remain down, I think that the Fed might consider a 50 basis point cut as well in September.
Steve, have the stakes just gotten even higher in terms of the Fed speak we're going to get next week at Jackson Hole?
I think it has. I think it's going to be interesting to hear how the chairman responds. It's worth noting he has not ever pushed back on the president. The president continues to place the blame for what's happening with the outlook to the economy at the Federal Reserve. The Federal Reserve has not responded. I don't expect the chairman to change his tune right there, but perhaps other presidents and officers at the Federal Reserve, officials at the Federal Reserve, will say, you know what, we were planning for a modest slowdown, one that's gotten much, much worse because of the tariff policies of the country.
Joe, Steve just mentioned that the chances of a 50 basis point rate cut are increasing. If we did see that,